In this example video, we're going to look at review exercises 14-8 and 14-9. So they tell us that the Bengals Corporation issued a 5-year 11% bond with a face value of $300,000 on April 1st, 2019 for $288,000. Interest is paid semi-annually on October 1st and April 1st. And so there's no interest that has to be accrued because we're selling it on an interest payment date. And we need to prepare the journal entries to record the issuance on April 1st and the first interest payment on October 1st. And they said that they use the straight line method to amortize the discount. So on April 1st, what we are getting is cash, and we're getting $288,000 in cash, which means we have a discount on bonds payable because we are selling it for $12,000 less than the face value of the bond. And again, your bonds payable can only ever go on at the face value, or in this case, $300,000. October 1st is the first interest payment that we have. So we know that we have to record interest expense for the period. We know that we have to reduce our discount on bonds payable so that it's at zero by the time that the bond matures. And we actually have to pay out cash to that bondholder. So our cash, $300,000 times our contract or stated rate of 11%. And we pay interest semi-annually, so we have to cut it in half. So we have to spend in total $16,500 to send out to those bondholders that we have. For our discount, we have $12,000 in total, and we divide it by the number of interest payments that we're going to make. It's a 5-year bond. They make 2 interest payments, so we have 10 interest payments that we make. So we're going to reduce our discount by $1,200, and simply the sum of those two values are going to be the amount of interest expense that you record under that straight line method. In review exercise 14-9, it says reuse the same information as above, except that the bonds are now sold for $318,000 rather than $288,000. And again, they use the straight line method, but now we actually have a premium. So on April 1st, again, we're getting cash. In this case, we're getting $318,000 in cash. We know our bonds payable can only go on our books for our face value of $300,000, which means this case we have a premium on our bonds payable for the difference of $18,000. And then on October 1st, we again are going to record our interest expense. We know we have to reduce the premium on bonds payable because it has to be at zero by the time that we pay off that bond. So we have an $18,000 premium on our bond payable. We have 10 interest payments that we are making. So that means we're going to reduce our bonds payable every time we make an interest payment by $1,800. The cash amount is something that is contractually obligated by the company. So $300,000 times that 11% interest times a half doesn't change, still going to be at $16,500 for us. And the interest expense recorded is going to be the difference between our cash that's being paid out and the reduction or the amortization of our premium on our bonds payable. Remember, we're recording less interest expense when it's a premium because we're going to be paying them less in a lump sum at the end of that 5 years. We're only going to pay them $300,000 when they gave us $318,000 to start. So it's basically seen as less interest over time versus under a discount, we record more in interest expense than what we actually pay out because we're going to give back more in a lump sum. We're going to pay back $300,000 in a lump sum when we only got a lump sum of $288,000. So it's seen as additional interest. That discount is seen as additional interest over the life of the bond.